Building a legacy starts with the bold decision to take a leap of faith. Behind every empire lies a foundation of grit, willpower, and the courage to take big risks. Welcome to Entrepreneurship Unlocked, where world shakers in the business world gather to share their stories. We're diving deep into the mindset of the modern entrepreneur to show you exactly what it takes to become truly unlocked. Join us in the pursuit of excellence with your host, Seth Rudin. This is Entrepreneurship Unlocked.
Good morning, entrepreneurs. Welcome to another episode of Entrepreneur Unlocked by Seth Rudin. I'm your business broker in the Pacific Northwest, and I love having great partners in the trade of M&A, customers, other subject matter experts. Today, I have the good fortune of being joined by Jonathan Frizzell of Kevil Kevil. We're going to talk about the sexy topic of cost segregation.
Hey, welcome everybody. Jonathan Frizzell here at Kevil Kevil.
Why don't you tell us a little more about yourself and Kevil Kevil?
Well, I'm coming up on 20 years providing professional services, anything that's tax related when it comes to fixed assets. And Kevil Kevil is a longstanding full service boutique cost segregation provider. We offer other services, but our bread and butter is cost segregation. And again, that's reclassifying yet to be classified or misclassified assets by accelerated depreciation. Certainly don't want to go on and on about Kevil Kevil, except that the founder, in fact, is, according to my competitors, the godfather of cost seg, who's been doing fixed assets since 1981.
We've been working with Jonathan for years as a firm. IBA's been around for 50 years. Obviously, neither of us have been doing it for 50 years, but Jonathan has been a partner to my colleagues and I in helping our customers save income tax. And he's going to keep it simple for you today. He's going to tell you what cost segregation is, and that's what we're going to dive into in just a second.
Looking forward to that privilege. Thanks, Seth.
Let's go. Let's have some fun.
Very good.
I know we love to talk politics and we love to talk sports. We're not going to do that today, though. We're going to talk cost segregation. So, Jonathan, for the listeners today, can you help us fully understand what cost segregation is?
Well, cost segregation it's been a term that's been around since the late 80s. It's a very distant cousin from component depreciation from the 60s and 70s. But the bottom line is you're accelerating depreciation on yet to be classified or misclassified. And what I mean by misclassified assets, that would be on straight line depreciation of either 39-year in commercial or 27.5 on multifamily. And what we're going to do is we're going to get them in smaller buckets of depreciable lives, usually in 5 and 7, but really it's 5 and 15 actually. And then whatever's left over is going to go back into section code 1250, which we'll talk about later, at 39-year and 27.5. It's not additional depreciation, you're just accelerating it. And we're going to increase one's cash flow by doing so. That's the short version.
Very good. So how does cost segregation accelerate depreciation?
Well, most properties, meaning over 90% of them across the country, are generally on a 39-year or 27.5. The IRS calls it look-back studies. I call them catch-up studies. You're catching up on what you would have gotten the first year of service. And the good news is it doesn't have to be new construction and new acquisition. So bottom line is that whether it's multifamily, office, owner-user, light industrial, self-storage, bottom line is you can get the catch-up condition whether you've been in service for 1 year or more, but it doesn't have to be new acquisition or new construction. And again, this is an engineering function that later becomes an accounting function. Oftentimes people think it's an accounting function, but the IRS, with ATG out of Techniques guy, they talk about engineering twice as much more than any other methodology, which is open to the public for one to see.
Is a good candidate a real estate only, or can it be a machine shop that leases their building, but they own a lot of machinery?
Good question. So on triple net light industrial, this goes for any kind of triple net, by the way, even double net. Sometimes to the naked eye, I think some properties are not as sexy as others. Believe it or not, there is still quite a bit of 5 and 15 year. So the short answer, Seth, to your question is yes, there is value in a machine shop that's being leased out. And once again, we're not going to necessarily touch the equipment of the tenant or the landlord, but it's the electrical. It's what's inside the wall, especially if you got plenty of 240 volt hookups. But we'll get into that later as well.
In your background, are you an engineer? Are you an accountant? What would you call yourself?
Absolutely not. Not a tax attorney, a tax tax professional, engineer, but most of our company is different cost estimators and construction type backgrounds, as well as civil engineers. My background is I'm nothing more than a third generation native of Seattle, the son and grandson of a shopkeeper who was in the hospitality industry for many years, who's really very customer service driven and very good with numbers. And I'm also a recovering wholesale lender as well. I was involved in that as well. So yeah, I'm coming up on 20 years in September.
Wow.
Yeah.
And if somebody wanted to be a cost segregator, do they have to have any technical background?
Boy, that's certainly helpful. I'm hell-bent on going in right to come out right. So it's all about the cost data. And, even if you don't get any blueprints and drawings from the client, then we got this thing called reverse engineering that we'd have to perform too. But, it's interesting. It's not in the Constitution, but not all cost site providers are created equal. So, but you've definitely got to be not only customer client driven, but you got to be really diligent and number driven.
So we talked about there's real estate as candidates for cost segregation. There's heavy equipment related business, not necessarily machine shops only.
Yeah.
Are there any other candidates that we should talk about? And then there are others that should not consider it?
Good question. So I always tell my Italian and Jewish clients, it's anything but a church, synagogue, or hotel. So, and a for-profit entity. By the way, credit unions and medical insurance providers that are not for profit, believe it or not, they hold their fixed assets in a for-profit. So the short answer is any kind of real estate that's a for-profit, and you name any kind of real estate, and I've done a cost seg study on it.
Great. Can you help a nonprofit organization like the Microsoft?
Well, Microsoft would be a for-profit entity.
But they're charity foundations, like Bill Gates Foundation.
I can help, believe it or not, I can help primary architect who designed the buildings on Section 179 EPAC study, which is a whole other animal for another time. That's also a very engineer-based study, which I believe President Trump is sunsetting after this year. But I can do nonprofits on Section 179, which is another conversation, another time. Energy study.
You're going to love this from a finance guy. What is the typical ROI or payback from your cost segregation study?
Well, it depends on the effective tax rate and how long it's been in service, the building, and then, of course, what product type is. But just so in your hearts and minds, and if you take $1 million depreciable basis, know that, 70 to 100K, can be in the pockets of the client. But it ranges anywhere from 10 to 1 to as high as almost 1,000 to 1. It just depends on how big the project is and what kind of product type it is. But there's always going to be a return. I've done as low because the client needed the tax savings. They needed the losses. I can go as low as 6 or 7 to 1 on after-tax ratio. But usually there's always good yield on cost seg.
Right. So let's make it a little bit more real for the audience. Can you walk us through where cost segregation significantly changed an investor's tax situation?
Absolutely. Without mentioning names, I'll give you a real life study. There's a client of mine on 4th Avenue that had a Jiffy Lube down on 4th Avenue when Paul Allen was still alive, that was buying up all the properties around there. And he was going to sell it to the Allen family and did before Paul passed away. And he called me up out of the blue and he said, Jonathan, I got $1 million gain. What do I need to do to go ahead and make that go away? And I said, well, Mr. So-and-so, I need a $5 million straight purchase with a minimum $4 million basis, preferably Class C, surface parking, multifamily. What does he do? Literally within 120 days. And it was nice to have somebody listen to the answer to their question and then execute. That's exactly what he did. $5.2 million purchase. I ended up accelerating over $1.3 million and his capital gains went away and he still had an extra couple $300,000 in depreciation expense to go against the rest of his rent rolls. So it's a great way to improve one's bottom line. This includes for lenders and brokers, bankers and debt coverage ratios and IRR. I can't touch the cap rate, but I can really increase the debt coverage ratios and the IRR. But that's the main one. So, I don't know if I'll have time for that, but that's another way to look at it.
How does the bonus depreciation factor into cost segregation?
Well, I want to give a little bit of a history. I want to go back to the genesis of bonus. Bonus was in 2002, and that's with the Bush in Congress to kickstart the economy because of 9/11, 2001. So bonus is anything defined as anything 20 years or less in depreciable lives. And of course, Bush in Congress rolled it back to 9/11, 2001, even though it's a 2000 to act. But it was only for TIs, leasehold improvements, and new construction to kickstart the economy. When 1.0 Trump came around, he actually changed and got the code changed to actual acquisition, which was huge for our industry. And of course, he's brought back 100% bonus depreciation on the 4th of July of last year in the big, beautiful bill. So short answer, it's anything 20 years or less. And the old days, before bonus was even around, whether it's acquisition or new construction, TI leasehold improvements, it was the cost seg benefit in the old days, meaning when I started 20 years ago, it was just you'd get the benefit over the first roughly 5-6 years of service.
Great. That's a great example for people. What are some of the misconceptions that you run into about?
Too expensive, too complicated, don't know, ask for too many docs, data. It's going to create an IRS audit. That's one of the biggest myths. I mean, it's been around since the late 80s. IRS lost their shirt in 97 with Walgreens, as well as Hospital Corporation America. They finally made it part of the IRS code of 2004. But probably the property's not big enough and there's not enough yield. And the biggest myth is for a lot of my residential brokers, I'm doing a ton of, more than I've ever done in the previous 15. The last 6-7 years, it's a ton of STRs and short-term rentals and long-term rentals. So, I've done as many as in Arkansas, 54 single families for one owner. So biggest myth is they're not big enough building, too expensive, too complicated, creates an IRS audit. There's other myths as well. So.
Hopefully you're okay with this question. To demystify one of these myths, what is the cost? If I have a $5 million building, I own the building, own the real estate, my first real estate broker is going to sell it. He brings you in, what does that look like?
Well, we'll just do depending on what part of the country it is, building land split, we'll say a $5 million purchase, $4 million on building and improvements, $1 million on dirt. So depending on what kind of real estate it is, you can reclassify or reclass, short for reclassification. You can reclass anywhere from 20 to 40%. So, if you take 25% of $4 million, you're looking at $1 million of depreciation expense. And if it's subject to 100% bonus, there you go. You get it all in the first year. And whatever you don't use, you don't lose. So you carry forward. So it's very powerful.
Are you getting charged by the hour?
No, heavens no. I charge basically on what it takes to get the job done and make sure I take care of my engineers. The pricing ranges anywhere. it depends. Obviously the big portfolio, 54 single family, it's economies of scale on that. But generally things range from anywhere from 4, 5, 6, 7, 8, 9 to 10,000. I did a big, huge outfit retail center. It was 400,000 square feet in Portland, and that certainly cost a little more than $5 or $6 grand to get her down. But we don't charge based on tax savings like the big four do. But I would say I'm not the highest.
Seems very reasonable.
Yeah, it is
for
great.
The savings you're generating, their income taxes.
Yeah, it's
like
huge.
A no-brainer.
Yeah, it's a no-brainer.
What's the percent? Like 1% where you don't save money greater than your fee? Is that even possible?
It's going to be 0% on that because I'm going to pre-qualify, and I look at federal tax depreciation schedules. This would be in 24 or 25, and I'm pre-qualifying anything before I look in the clouds and then submit it to my engineers because I try to respect my time with my engineers. When I submit my analysis and for it to come back, I've already done a pre-qualification on what is worth looking at and what's not. I will say, commercial disclosure, fifth generation Italian family in Seattle, the Borghinis, early in my career, I did their warehouse, which was on the old 31.5 schedule back in 92, and it was back in 06, 07, the tax year. Anyway, that record still holds in my career. 54.5% of depreciation was gone, and I still brought value to Angelo and Dora Borghini. They're no longer with us. The tenant is a bakery. Sports Brothers Bakery is the tenant inside there. But anyway, there's value on that. So getting back to myths, the biggest myth out there among owners and tax professionals, with all due respect, is, well, after 5-6 years of service, there's no value. Well, if you're looking at 39 or 27 and a half years, you have to remember that's a timing difference. The short end reply to that is, no, there is value for sure. You just have to run the numbers.
What does the IRS look for when you want to defend your cost segregation study?
Well, they look at things just the antithesis and the opposite of what a CPA or an owner would look at. They want to look at how the study is put together. I mean, they like the economics and they want to see the numbers, but they want to see what's put together. They also want to know, is it somebody in-house that did the on-site business, qualified professional? And also they're going to look at the building land basis, whether it's a straight purchase or a 1031. How did they arrive to that building land basis, which is another conversation another time.
Very good. And how did they avoid an audit?
Well, I will say this, and in the 20 years I've been doing this, audits usually happen to something else on the client's file, and then they happen to look at our study. And cost seg studies do not necessarily create an audit. There's something else in the client's file. If they get too aggressive on a building land basis, maybe that's something that the IRS will look at. But for me, I try to make that an intimate decision between the tax professional of record and the owner. A lot of my competitors are pretending they're valuators and they're inflating the building basis so it can inflate their benefits. And I was just talking to the IRS agent at our society conference in Vegas, and they frown on that big time. And again, that's a professional, intimate conversation discussion with the CPA and the owner, not the cost seg provider.
Makes sense. You've touched on these before. How does cost segregation interact with the 1031, the short-term rentals, or another real estate professional segment?
Well, in the old days, the 1031, meaning before Trump 1.0, you actually had a duality of deferment. You could actually cost seg the replacement property as well as the relinquished. Now it's just the replacement property. Doesn't mean you can't do a cost seg if it becomes a relinquished property. But as far as 1031s, they're still very complementary. You hear that David Moore from Equity Advantage, swap until you drop. Well, really all the families I work with, they not only swap until they drop, but they also cost seg because you don't concern yourself what the basis is going to be, especially in advanced age. So again, 1031 cost segregation studies are still very complementary. One thing you have to remember with the replacement properties, the net excess depreciable basis minus land, you do have to have some kind of basis to work with on the replacement property. But I do a ton of 1031 properties.
If someone is going to buy or sell a property, when should they start engaging?
Well, I always like to go before so I can help them tax plan, but oftentimes I don't see even
before closing.
Yeah, before closing is the short answer. We want to do that for the broker, and you want to do that for the buyer, so you can help that tax plan. But any time. Before is the best to answer your question.
And if a sale occurred and they forgot to, and the seller they haven't reported their next year's tax return, is that still enough time to have you do the cost segregation?
Good question. No value for the seller. If it was 10 years ago with the old 1031 rules and it was a 1031, it would still make sense to look at the relinquish. In this case, it would be just the buyer only.
Maybe I confused you probably. Not any investment property, not a 1031. We just sold the property from a seller. So I sell a business, has real estate or heavy equipment.
No value for the seller if they're going to sell or have sold.
Right.
Yeah. But the buyer, yes.
Yeah, I understand.
Yeah.
Very good. It sounds, when I talk to you, always on top of all the tax stuff. How is it that you're so well educated on all the current tax situations? It's very impressive.
Well, I just have to have the will to do the right thing and to stay on board. And I've been that way in any industry I've been in, is that knowledge and tools, and it's important to have those. And I just probably guessing that came from my father's side of the family. You got to go in right to come out right, and I'm hell bent on coming out right.
Great. It's very impressive. Everybody that I've met who knows you, and you know a lot of people, we see each other everywhere on the different networking events and different clients of ours, and they all have a high degree of respect for you. So,
well, I appreciate that. Checks in the mail. I wanted to know that I get a kick out of Gregory and the entire firm and IBA and all hardworking professionals, every one of them that I've met. And it was one thing I learned, and I got this certainly from my father's side of the family, is that if you can bring value outside of your own services or whatever that you do, be complimentary to other people's books of business and, bring value. So that's important. And I don't know, it's just how I've been that way since a little boy. So I'm not going to change, I guess.
Awesome. Very good. Well, I really appreciate having you on the show. Is there any way, if somebody in the audience wants to contact you, all have their information, that you want to share Any way you prefer to be contacted?
Well, yeah, you can get a hold of me anytime. I've got the same number since Christmas of '97. So, phone number is area code 206-399-7769. Phone number again is area code 206-399-7769. And, my email address is Jonathan. It's just Jonathan at Kevil. K as in Kellogg, E as in Eduardo, V as in Victor, IL. That's Jonathan at Kevil.com. But I'd love to be available 5 in the morning till 7 at night. So you can contact me anytime.
Very good. When you love what you do, you make yourself available.
That's right.
Thank you, guys. You can find us on Apple, Spotify, Amazon, and YouTube. Have a great day.
Thanks, everybody. Have a blessed day.
Thank you.